Let's step away from trading for a moment and talk about how an investor uses options practically, because this is where a lot of people miss the point entirely. Options are not just for traders chasing moves, they are a tool, and in the right hands, they solve real-world problems that buying and selling stock alone simply cannot. Here's a scenario. You own a stock. It pays you a dividend of around 4.5% per year. Solid income. You like that. But you've been watching the company closely and your gut is telling you the growth story is done for now. The stock just had a solid run-up in value and you're thinking that money could be working harder somewhere else over the next 5 years. You've already got your eye on where you want to move it. There's just one problem. The tax year is ending soon and you've already had a good income year. If you sell the stock now, you're handing a meaningful chunk of that gain straight to the tax office, on top of everything else you've already earned this year. So you wait. But waiting means sitting in a position you've mentally already moved on from. This is where the covered call earns its place. You sell a call option on your stock, but not just any call. You go deep in the money, meaning you choose a strike price well below where the stock is currently trading. Why deep in the money? Because at that level, you are almost certain the stock will be called away from you at expiry, because it is highly likely the stock will never end the contract lower than that strike price, surely. That suits you perfectly. You have decided in advance to sell your stock anyway, and you are completely comfortable with that outcome. It is essentially a sale you have already decided to make, just delayed to the other side of the tax year. Now here's what that option price looks like. Because your strike is already below the market price, the contract carries intrinsic value inside it from the moment you sell it. The stock is already worth more than your strike, so that gap is baked into the premium you receive. On top of that intrinsic value, you collect a little extrinsic premium as well, time value. So your total premium received reflects both. While you wait for expiry, you are still holding the stock, so the dividend keeps paying. You're collecting your 4.5% income. You have the premium from the option sale sitting in your account, and your effective exposure to the stock dropping has been dramatically reduced because the deep-in-the-money strike gives you a significant buffer before any downside actually starts hurting you. The stock would have to fall all the way below your strike before you felt real pain, and at that level, you'd essentially be buying it at a bargain anyway. When expiry arrives after the new tax year begins, the stock gets called away. You receive your money, clean, and now you're free to rotate into exactly what you were eyeing off all along, in a new tax year with a fresh income slate. You held longer than the market would have forced you to, you got paid to wait, you kept your dividends, and you moved on at a time that suited you, not the tax calendar. That is one example of how investors use options practically. Not to speculate, not to chase volatility, just to solve a problem that straight buying and selling could not. You can also use this strategy to just make extra money from holding your stock. You could sell a call option on a strike at the money or just outside the money, above market price, and get a larger premium in the pocket. Some investors do this month after month to make extra income. The world is large with options. Take it for a test drive on the Passive Nomad Simulator. It's the best tool for replaying market history. Choose your expirations and watch how decay and volatility impact your position in real time. Free to use, cutting edge, and includes 0 days to expiry simulations. This is where theory meets reality.